I'm going to talk about a strategy that you can turn $10,000 into $1,184,186. Now, there's not just one strategy when it comes to investing. Some work better than others, but there's not just one. But most importantly, I really want you to take away from this video what you're probably doing wrong, what's causing you not to get a better rate of return. Now, if this is your first time at our channel, welcome to the channel. And if you're returning to our channel, welcome back. My name is Travis Sickle. I want to get right into this, so I'm going to go ahead and pull up these charts. I want to walk through them, but let's start at the beginning with the S&P 500. The S&P 500, this is a pretty neat chart. Now, here is the S&P 500 index, and you're probably like, what on earth is this page? Let's go ahead and zoom into the rates of return over the last from 1926 to 2020. So this is what we call a matrix chart or a matrix chart for the rates of return of the S&P 500 over time. This is annualized compounded. So from 1926 to 2020, the S&P 500 did 10.3% on an annualized basis. That's pretty cool to see really quickly between two dates on this chart. But I wanted to point out over the long haul at 10.3%. So that is what you could have earned over that time frame, 10.3%. We can do the math really quickly. That's 94 years, by the way, if my math serves me right. If you invested for 94 years, like who's going to invest for 94 years at a 10.03% rate of return, and you started with, let's say, $10,000. You know what? Let's say we put in $6,000. That's what you can put into a Roth IRA, right? And we never did anything again. That would be $71,737,983. That's crazy math when you're thinking about it. You're just going to invest one time $6,000, but that's over 94 years. Now let's pull up this chart from First Trust. So this was put together by First Trust, and these dates are going from not the same dates that we just saw, but this is going from 1979 all the way up to 6/30/2021, so fairly recently. And it's showing you the growth of $10,000 invested in the S&P 500. So let's start right there. You can see it missing the best 50 days at $84,580. So that's $10,000 is how much money you would have, but you missed the 50 best days. Now let's not miss that many days, but let's bring it down to the next one where we're missing the best 30 days. So we eliminated the best 30 days, and look at that. If we did that, then we would have had 10,000 would have grown into 191,686. If we missed the best 10 days, we're at 528,829. So you see where this is going towards, that we're taking out the absolute best days. Now think about that over time. We're talking about from 1979, remember there's 365 days in a year, 1979, I'm not doing the math, 1979 to all the way to 2021, and we're only missing the best 10 days, and we got 528,000. But if we took only missing 5 of those days, so now this is going to go up to 734,212. So where's the trend going? All the days. If we never missed a day, that means we invested in the S&P 500, we set it and we forget it. That means it would grow to $1,184,186. Now, you might be thinking, what really is the negative, or what's the cause of losing money in the stock market? One of the biggest culprits of losing money in the stock market is not, you can't see it from this chart. Yeah, you're missing some of the best days in the stock market, and you're probably thinking, well, just don't miss the best days. You know, you can try to miss those mediocre days or the worst days in the market. Obviously, you want to miss all the negative days in the market. But this is what the reality looks like if we flip over to this other chart here. And this is what reality looks like, but it's not what we feel. We feel that all we're looking at, and what you're looking at right here, is bulls and bear markets. Look at that. The gold, the yellow, are the bear markets. But look how much more bull markets there are than bear markets. But we spend a lot of time fearing, worrying about down markets. But look how infrequently and short-lived they really are. But the other thing that's really interesting to me is the average bull market period lasted 4.4 years with an average cumulative total return of 154.2%. That's great. But what we focus in on is the bull market that's lasting 4.4 years, and then we immediately try to apply it. So we say, well, if the last bear market was 4.3 years ago, then we should get out of the market, right? No, because that's just an average. Because look at these. If you had done that, I mean, how you would have missed all this upside. Look at 12.3 years was this bull market right here. And look at that. You would have missed all of this upside over here if you got out at 4.4 years because you're looking at those averages. So they're really difficult to kind of figure that out. But in timing the market, that's what you miss. And then you flip back to that other chart that I just showed you, and it's significant. And that's really the important part that I'm trying to point out, is that trying to time the market when you're invested in this strategy, and that's diversification, that's investing into the S&P 500. Don't confuse this with other strategies. So, and I think that's where a lot of people kind of tend to lean towards, is they try to use multiple strategies at the same time, and that causes a lot of problems. Like if you're trying to go into individual stocks, I wouldn't look at investing like this if I was invested in individual stocks. Look at it a little bit differently, but if you're diversifying your portfolio, this is really relevant and really important. So trying to time the market usually ends in disaster. Maybe just not disaster, but look at that. You have to work how many more years just to get to the same point? I mean, that's something that you probably don't want to do. You want to be as efficient as possible. It's thinking that you can get out just to get back in at a better price, but you're looking at it, you're applying the wrong strategy. It's diversification, diversify, and dollar cost average. Keep saving, keep building that wealth, keep building that retirement plan. So 10,000 to 1.1 million, and you really just had to start saving those dollars into the S&P 500. That isn't bad at all. If you enjoyed this video, like, subscribe, and leave a comment down at the bottom.